anybody who's absolutely certain about how it's going to play out is either not that smart or they're lying to you with some agenda in mind.
Right.
Don't turn off your 401k contributions because you're worried about the market going down. Like, use this as an advantage to you. So that is not the type of environment that's conducive to long-term success. And that's what we're going to get into today.
So immediately I called David. I was like, what is happening here?
Welcome to the podcast, Retirement Done Right, hosted by David Rath and Pat Kalish. We tackle various topics such as retirement, Social Security, taxes, estate planning, wealth planning, and more. If you have further questions or want to learn more, we would love to hear from you. You can reach us at contwealth.com. Please note that the information discussed on this podcast is for educational purposes only and does not constitute professional advice. Listeners should not act upon the information or content without first seeking the advice of a licensed financial professional.
Hello and welcome back to another episode of Retirement Done Right, where we attempt to guide you through the complexities that life has to offer when you are entering your retirement years. I am David Rath, and today we are going to be discussing a topic that's on everybody's mind. You can't get away from it. It is tariffs and the impact on the markets, on financial plans, on your psyche. It's been a very challenging time, so I'm here again with my co-host, Pat Kalish, to help everybody sort through the madness. Pat, how's it going?
It's going good. Looking forward to today's conversations. Know that you've been buried in the charts, so interested to see what David Rath has to say on the topic.
It's been a challenging week. We've fit an entire year into a week's worth of time. And our clients know that we've been very proactive about how we've been communicating things, how we've been managing risk in the portfolio. And we're going to get into that in just a bit. And for this conversation, Pat's going to be driving the conversation. We're going to be switching seats, so to speak, because usually these are very financial planning focused. And today we're going to be talking about a lot of what I do in my role as a portfolio manager, as the chief investment officer here. So just before we get started, I want to remind everybody to please like, subscribe, comment, leave a review. It really helps us expand our reach when it comes to these sort of videos. So if you find them helpful, we would very much appreciate if you spread the word. So Pat, I will turn the mic over to you and fire away.
Awesome. I think I want to remind all of our listeners, today's April 9th of 2025, and there's been a lot of volatility that has happened literally intraday. So just keep that in mind. But, David, let's just start off from the top, right? Recent headlines around tariffs, it's caused a lot of market uncertainty. So would love to just hear from you. Give us a quick recap on tariffs and just the current market environment.
I think everybody is sick of the word tariffs. I know I am. You can't open a news article. You can't turn on the TV. You can't have a conversation with people without talking about tariffs. Yeah. So I'm pretty sure most people have a general idea about what the tariffs potentially are. And they are subject to change, as we literally saw before we signed on here to do this podcast today, where an announcement came out that there's a 90-day pause. We had a false start earlier in the week that there was going to be a 90-day pause, but it was a fake news headline. And so the fact of the matter is that tariffs can essentially accomplish a few different objectives. They can be a revenue generator for the government. They can be a way of negotiating for some other deal besides the target of the tariffs. Or they can be a protection of current industries that are inside the country. I'd say that the projected tariffs that he rolled out last week were more of the third option there, where we're trying to bring manufacturing back to the United States, bring things that were formerly produced here that we outsourced to other companies for cheaper cost of input and labor and that type of stuff. He's trying to bring that back into this country. And so I'm not going to comment on the effectiveness of tariffs, on what the future holds, because honestly, nobody knows. And that's really a fool's errand, trying to project like how this is going to play out. Economics is a very, very inexact science. And so I'd say anybody who's absolutely certain about how it's going to play out is either not that smart or they're lying to you with some agenda in mind. So that's kind of like the environment that we're in right now. It's very news driven headline as we're seeing markets going through crazy fluctuations on an intraday basis. Just today, the market was down, I think, 2% when we opened today. Last time we checked, like as of a second ago, it was up 8%. So that is not the type of environment that's conducive to long-term success. And that's what we're going to get into today is the effects of not only market movements like this, but also negative market environments and how it plays into investors' psyches and how they think about the world as they project out moving forward.
Yeah, I love that. I mean, that's for our listeners. Like, I was preparing for the podcast and I just jumped up and I looked and I saw that the market was up like 8%. So immediately I called David. I was like, what is happening here? So I'd like to, like, before we kind of veer away from that topic, are we seeing, do you think markets overreact to this short-term type news? And if so, like, what indicators are you using to try and kind of look past like some of this noise?
It's so hard in an environment like this, and the best analog to what we're currently experiencing is what happened in COVID, where there was a lot of fear baked into the market in COVID. There's a lot of fear baked into the market right now because if the tariffs went forward with what they were initially set out to be and the rates that they were projecting, that would be probably a very bad environment for the overall global economy. And so,
Right.
what is happening in a fear based environment like that is you're seeing not only people selling because they're rapidly changing their opinion about the future and what that future can hold for the economy, but now you're also seeing people that may have borrowed money on leverage to invest in the market. Now they're being forced to cover those trades and they're being forced to sell in order to meet what's called a margin requirement. And so there's so many things that are happening under the surface. You almost have to throw like traditional measures of analysis and chart reading and what I do. 'Cause a lot of it goes out the window because when things are just plummeting straight down,
Yeah.
it's really just sellers have taken control. There is way more supply than demand, and where it stops going down is anybody's guess. And so what I like to do and what we've done here, as we mentioned, we were proactive as far as going to a more defensive posture before the announcement came out. And that was not in any manner us predicting what would have happened when he announced what he did on April 2nd.
Hmm.
That was us following our process. That was us using indicators that we've used for a while within our tactical models. So we were making prudent decisions based on our process. We weren't predicting the future. So
Yeah.
to answer your question, it's very hard to analyze a situation like this because the 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 slightest news or fake news even can drive a market up or down. And so the best thing to do is just kind of let the dust settle, take what you've already done, which we've already done, and
Yep.
let things play out. And then once things normalize, once the market gets some sort of stability to it, now it becomes a little bit easier to maybe redeploy some of the cash back into stocks or maybe sit out even further if the market continues to go down. So we're playing a waiting game right now because we've already done the necessary steps in order to protect some of our clients.
Yeah, I'll never forget that team meeting too. And this was pre-Liberation Day. And I remember you talking to us about like some of the moves that you were looking to make. I remember you said, "Hey, these moves, like, this is based on our process. And we don't know what's going to happen on Liberation Day, right? Like, potentially the market might get some good news and it might rally. Or on the flip front, what happened was the market got, more negative news and it really started to see that spike down." But I remember you saying, like, we're not trying to, we can't predict the future, but a part of our process, we're taking some off the table and it really did work out. So kudos to you.
Yeah, and it did work out in our favor. And I wrote this in our communication after Liberation Day, which was if in an alternate universe, he announced the tariffs that are potentially going into place right now, which is 10% across the board, not really any sort of reciprocal tariffs, except being as they are being applied to China. If he had announced that on April 2nd, I would say that the market would be doing exactly what it's doing right now, which is rallying. And we would have said, well, we wish we didn't go to cash with some of our portfolio. again, we were following our process. We weren't necessarily predicting what would happen. It worked in our favor and our clients benefited from that, I would say. But there was a little bit of luck involved because of the way that it unfolded.
Yeah, I think, let's flip gears because like we have a very defined process for how we manage portfolios. And it's sometimes tough to not let emotion kind of get in the way. So let's flip gears. If say, you have some of those emotions bubbling up, let's talk a little bit about like behavioral finance and maybe investor reaction. So just basically your read of the play and having client conversations, like how are you seeing kind of these behavioral biases just showing up in investor behavior during these periods of market turbulence?
The funny thing about investors, and I'm one of them, I'm a human being. I still have
Yep.
biases built into myself. That's why I prefer to follow a process and defined rules and not making predictions and not getting emotional because I am a human being and I still make mistakes and I'm just as liable to feel some of the pressures that we'll go through and some of the biases that can unfold. And so when it comes to investing, we as a species are just very not hardwired to have success. We essentially do the opposite of what we should be doing, and that is being very myopic about our focuses on the current environment. We have what is known as a recency bias, where we take recent events and as we're projecting out into the future, we assign a higher weight to those recent events versus, let's say, the last 5 years. So we take the market decline from mid-February until now, and we're like, if this continues, my portfolio is going to zero. We know that's probably not the case. And so what we do as a species, though, is that we take those recent events and we assign a higher probability to them just because that's what we're hardwired to do. The other aspect that really, and it plays out in this situation too, because in February, we hit all-time highs in the stock market. All-time highs are great. Everybody feels great. Their portfolios are green across the board.
Yep.
And what we do is we anchor to that top value. If we were to say, and I don't have the numbers in front of me, but if we were to look at like the market from 2022, and as the market started to go up, we bottomed, I think, in October of 22. I would guess that the return of an S&P 500 fund from October 22 until now, probably 40 to 50%. That's just me ballparking it. But because we went up, let's say maybe 60% first, and now we're down to where we are, that now we've anchored to that top level, and it feels much worse than if somebody had just woken up and not checked anything other than their portfolio value. Rip Van Winkle goes to sleep in October of 22, wakes up today and checks his portfolio. He thinks everything is fantastic because he didn't experience the up and then the back down. And that's the aspect of behavioral finance that is so hard to combat because we are hardwired to take recent events, assign a higher probability to them projecting out into the future, and we also anchor to that top level because we realize like we used to have that, now we don't anymore. And that brings me to the third aspect of what I wanted to talk about, which is we feel losses almost 2 times as much as we feel gains. And what I mean by that is Daniel Kahneman and Amos Tversky, they won a Nobel Prize for their work on behavioral finance. And they ran a ton of experiments about how people think about money. And one of the things that they came away with was if you are offered a choice, most people, and this includes pretty much everybody, you would rather a situation where you avoided a loss versus got a gain just because the pain of a loss is almost 2 times as much as the joy of gaining money. And so all of those three factors combine to the environment that we're in. Fear is at an all-time high. And so us as advisors, we are trying to focus on the big picture, focus, and this is your arena, focus on financial planning, really resetting the expectations and what that long-term plan looks like.
Yeah, I love that. I'm glad you brought up anchoring because I see it sometimes less from the portfolio perspective and actually like more from the financial planning perspective. I get a lot of clients that are like, well, I need $1 million to retire. And they set that goal in their head. They've had it for forever and they're anchored to that goal. And for those pre-retirees out there, right? Maybe you were close to 1 million and now with this pullback, you're a little bit under that mark, but that doesn't mean you can't retire. Right? It's the cash flows that actually can tell you whether or not you can retire, depending on how much you want to spend. So definitely be a little bit careful when it comes to anchoring. I think the other thing, we talked recency, but I also want to bring up, there's another bias out there called like the framing effect. So basically it's like decisions are influenced dependent upon the information that's like presented to us. And I think mainstream media, like, I mean, they are really causing a lot of unrest. And I hear it like when I'm on meetings with clients and we're having discussions, I'll ask like, hey, what do you have on in the background? And a lot of times it's one of the mainstream media channels. And they are just looking to capture people in front of a screen for as long as possible. And a lot of times they're doing that through very negative news stories. So I think being mindful of that and trying to kind of tune out some of the noise and really focus in on like your long-term goals and your long-term strategy is just so important. So
That's so true. And I just want to add my 2 cents there is even if it's business news like CNBC or Bloomberg, their objective is not to quote unquote make you smarter. It's not to make you money. It is not to make you a better investor. It is to keep you watching TV. It is
yep.
to keep you reading the newspaper. And so there will be a tendency towards that negative news cycle. Negative give there's a saying in the news industry, if it bleeds, it leads. That's because we like to tune into bad news. It scares us and it keeps us glued to the TV because that person on TV, they know what's going to happen next, or at least they're purporting to. And so we will tune into these news programs. It doesn't matter which news program it is. Their objective is the same. It is to keep your eyes glued to the TV. And so people are actually surprised when I tell them that I don't read the newspaper. I don't watch CNBC. I don't watch Bloomberg. I don't watch any of that stuff because I don't want any of that seeping into my thought process. I don't want to seep it and any into what I think about as I'm navigating these financial markets. And so the big news finds me, right? I'm obviously aware of things that are occurring in the world, but I'm not going to be glued to the TV having a talking head tell me what's going on.
Yeah, and I'm doing a lot of client meetings, so I'm like on the flip front where I am trying to like read the big news headlines because like for me, I'm trying to also get out in front of it. I know these topics are going to come up, and then I want to be able to discuss that like we come to work every day to manage your money. It doesn't matter who's in this, who's what party is in the White House. Like it does not matter to us. Like we are here to kind of help you achieve your long-term goals. So I think it is so important to just try and tune out that noise. And I know it's hard, but it's sometimes very important to do. So we talked a little bit about tariffs. You know, we talked about the extreme volatility we've seen in the market and some of these behavioral type biases. Let's flip gears. Like, what should investors do during time like this? So I'll hit you with this one, David. Like, what adjustments, kind of, if any, are you kind of considering within the portfolios given this current environment that we're in?
I'll tell you the one thing that people shouldn't do, which is panic.
Yeah. Yep.
And this highlights the the benefit of having some sort of plan in place going into an event like this. That plan could be, I'm just going to sit tight and ride out the volatility. That is totally fine, right? I would say most people are familiar with that style of investing where I'm going to buy a diversified mix of investments and I'm going to let them do what they need to do and ride out the ups and downs. A totally fine way to invest. You can run into some situations where your metal gets tested, where we've talked about it before on the podcast here. In 2008, during the global financial crisis, a balanced portfolio, 60% stocks, 40% bonds, was down about 35%. So, quote unquote, conservative type investment was still down 35%. Imagine the retiree that handed in their papers at the beginning of that crisis. And now you're looking at a portfolio value. Let's put some numbers to it. You have $1 million. Now you're going into retirement a year later and you have $650,000. That is really scary. But if you went into that knowing that that is a possibility and your plan was you have a what has been sometimes referred to as like a war chest of cash and short-term bonds, that's going to be your plan to ride out the ups and downs of the market. That is totally fine. The challenges of that style of investing, and we've seen this in recent days, is that when things start to get really crazy, everything starts to move together. You're seeing everything sell off. You're seeing bonds sell off. You're seeing gold sell off. You're seeing stocks. All of that starts to move together. And that's where it gets really scary. There is a great line, I think Brian Portnoy in his book, The Geometry of Wealth, which is a great book, by the way. If you're ever interested, I would highly recommend that. He has a great line that says, diversification is always there for the party, never for the funeral. Meaning, as markets go up, you're looking at your diversified portfolio and you're saying, why do I own this thing? It stinks. Like it's lagging everything else. And so it's diversification feels like a drag on the way up. And then in a rapid sell-off like we've seen recently, everything just goes down together. And you're like, where's that diversification benefit?
Right.
So again, going into this situation, you should be very, very clear about what your plan is. And we internally, we talk about this stuff every week. I give my outlook on what the markets are doing, but also how are we positioning ourselves according to the plan that we've put in place from a portfolio perspective.
Yeah. I would say on the flip front too, there's a lot of opportunities that you have from a financial planning perspective. So I would say look at this pullback and look at these pullbacks as ways that you can set yourself up a little bit better for the future. I mean, things like Roth conversions. It provides a little bit more of a tax efficient opportunity to convert some of those pre-tax dollars at a lower value to after-tax dollars, to Roth dollars, so that when the market rebounds, it's all tax-free growth. You could look at things like your spending strategy. We talked a little bit about this, about like the guardrail strategy. And if the market continues to sell off, even just a small little cut to your overall expenses, I'm talking like maybe 2-3% on your overall expenses from a yearly basis, can really allow that portfolio to stabilize and to really continue to grow back on the upswing. And then also I would say like review some of the holdings. We work with a lot of clients that have legacy type holdings where they've had these investments for a long time and they have a pretty significant cost basis. Maybe it's time to review those. And if it doesn't fit with your long-term plan, maybe it's time to kind of whittle those down so that you can start to re-diversify those assets into a broader investment strategy that's really going to fit for your long term. Other thing I want to hit you with, David, for our pre-retiree clients or our accumulators, the importance of dollar cost averaging. And I bring this up because I just had a conversation with a client. They were putting a lot of money into their 401k. And they said, Pat, does that make sense for me to continue to do so? It seems like I'm putting money in and the money's just going out. So I'd love to kind of get your take there on the benefits of even dollar cost averaging.
And let me define dollar cost averaging. I think that's a term that we as the industry professionals, we throw a lot around a lot, and we assume that everybody knows what we mean by that. And essentially that's just contributing or buying a structured amount every single week, every other week, depending on your paycheck, or if it's in cash, you're just putting it to work every single time period without thinking about it. And so
Right.
the averaging part of that phrase is because as you're investing, sometimes the market will be up, sometimes it'll be down, and you're getting an average of prices over that period of time. It is a very, very powerful tool for people who are actively saving to their retirement plans, and especially in a 401k plan, because you are not even thinking about it. You're just looking at your take home pay. It is just automatically happening. And that dollar cost averaging process is allowing you to take advantage of these dips in the market. And there's a famous, I want to say it's Warren Buffett. I just think every investment quote is attributed to him. That is, the stock market is the only place in the world where things go on sale and people run out of the store. And so we talked a bit before about what not to do during this time frame. Definitely don't, unless maybe you have some immediate cash flow needs, which probably then you have a bigger planning discussion to have.
Right.
Don't turn off your 401k contributions because you're worried about the market going down. Like, use this as an advantage to you. Take advantage of the market being 20% off from where it was before. And so to talk about to touch on the things that you mentioned from a planning aspect, I believe in being very pragmatic about things and things that you can control. And so when something like this happens, don't panic within your investments. Look for opportunities to make it a silver lining. And so obviously none of us want to go through this. It's not fun for either side of the desk, believe me. But you can look for opportunities. You mentioned the Roth conversions. Now you're paying a lower tax bill than you otherwise would have, and you're just shifting to a different account, same investment strategy. So you're not missing out on any rebound. So you're paying lower taxes. You're keeping the investment strategy the same. In a similar vein, tax loss harvesting is something that we do for clients. Unfortunately, because of the crazy moves in the market, I haven't been able to identify a good time to do that in the last 3 days. It's not a great thing to do as the markets are moving around very intensely as they are. But it is another opportunity for you to not change your investment strategy, but maybe take advantage of some losses in the portfolio and lower your future tax bill. And so all of this plays into, there's a great sketch from Carl Richards where he has the Venn diagram of things that matter and things you can control, right? And that intersection in the middle of them, that is what you should focus on. You can't control the market going down. You can't control what the future tariff rates look like. What you can control is your plan going into an event like this. And then after it happens, what do you do to take advantage of that situation? Focus on that control.
We have covered a lot today, and this has been, extremely helpful for me to hear as well. So really want to kind of end on this. I mean, David, from your seat, what do you think the most important message that we should be communicating to clients right now is?
Have a plan in place. It's something, and that word plan can be very broad in nature. And that plan can be from an investment strategy. It can be from a financial planning perspective. It can be from a tax perspective. All of this stuff is could be beneficial, and actually probably will be beneficial in the long run for people that have a plan in place, because it does allow you to take advantage of some lower prices in the market. And it does allow you to take advantage of some planning opportunities. It is very painful to go through for all the reasons that we just discussed from a behavioral finance perspective. But given the right situation and given the right plan that's in place, you can actually make it work in your advantage. And I will say this to anybody that will listen. I never ever tried to predict the future. It's just the silliest thing that I can think of. Nobody has insight into the future. And so what we try to do is talk to our clients, and we discuss this internally about what can we control, what sort of value that we can provide from an investment management perspective, from a planning perspective. All of that goes into the value that we believe we provide for our clients.
Yeah. I'm, relatively new to Continuum, but I just think this is kind of the first type of, you know, intense market event that I've experienced with the team. I would say like just the communication is key. And we communicated through the newsletter, through these podcasts, before you made the moves, after you made the moves, before and after Liberation Day. And I think that's just so important. But I would say to clients that are listening is, if you're concerned, like, let's have the conversation. Like, set time up on the calendar. Like, that is why we're here. Before you make any knee-jerk reactions, let's talk it through to make sure that that's going to be the best move that you can make long term. So,
Yeah.
with that said, David, anything else that you'd want to kind of wrap up with?
No, I thought this was a very good idea to go outside of what we would typically be talking about today. I think we had Medicare lined up on the docket of
A
topics.
little different, but
It's one of those important but not urgent things.
yeah.
There's things that are on people's mind right now, and so we wanted to get this episode out specifically. It'll probably get released in about a week, and everything's probably changed on the news front, but the principles of what we talked about today, those are timeless.
Yeah. And I think we will be able to point back to this podcast at another point in time, because these things happen. We need to continue to remember that same message.
Yeah. Well, thanks for jumping on. We really appreciate everybody that interacts with us, that comments on our things and sends us messages. We've gotten a lot of positive feedback from clients as we've gone through this event together. And as you said, it's your first one. It won't be the last. Hopefully they're spaced out a little bit more. We like the good times at the markets much more than the bad times.
Yep.
But this is where we truly try to take as much stress from our clients as we possibly can. And as we talked about all today, the different ways in which we do that for people.
Man, great way to end. Thanks, David.
Yeah, take care. See you guys.